All right. Good evening and welcome to the CEPR-TFI event on the topic of Big Tech and Fintech. My name is Andreas Fuster. I'm an economic advisor at the Swiss National Bank and the co-organizer of tonight's event. So the plan for the event is as follows. We will start off with opening remarks by Mark Cliff, who is the Chief Economist and Head of Global Research at ING Group. He will give an overview of the Think Forward initiative and also share some thoughts on the topic of the event, Big Tech, Fintech, and what it means for banks. Then we will move on to the main part of the event, which will be a panel discussion featuring three distinguished experts on the topic. We have Devie Mohan, co-founder and CEO of Burnmark, Leonardo Gambacorta, the head of the Innovation and the Digital Economy Unit at the Bank for International Settlements, and Tommaso Valletti, Professor of Economics at Imperial College London. The way we agreed to do this with the panelists is that they will each introduce themselves at the beginning of the discussion, but let me just take a couple minutes and introduce our distinguished moderator, Amit Seru. Amit is the Stephen and Robert Denning Professor of Finance at the Graduate School of Business at Stanford University. He is also a Senior Fellow at the Stanford Institute for Economic Policy Research, as well as the Hoover Institution, a Research Associate at the NBR, and the co-editor of the Journal of Finance. Amit has published extensively across different areas of financial economics, including corporate finance, financial intermediation, and regulation. And of particular interest for tonight's topic are certainly his writings on non-bank financial intermediation, where he has done some pioneering work trying to understand which factors drive the rise of non-banks, of shadow banks in financial intermediation, with better financial technology as one of the key factors. So we are very fortunate that Amit made the rather long trip from California to be with us here tonight. So with that, I'm happy to give the floor to Mark Cliff for the opening remarks. Thank you.
Thanks very much. Well, literally a warm welcome to this event in Rhodes. I mean, we somehow end up in sort of darkened rooms. I don't know why, but anyway, hopefully we can lighten the mood with some upbeat discussions about the potential for the technology. So as you said, I'm the Chief Economist of ING. Those who've not met me before, I do more than what I call the day job, which is macroeconomic forecasting. And that's why I'm so inspired by the Think Forward initiative, which is a multi-stakeholder collaborative effort to help people make better financial decisions. So we are very, very grateful to the CEPR's support in this regard, because obviously the foundation of this is good quality research and insights. So I'm just going to take a few moments to begin with to update you on where we stand, and I think we've got a pretty impressive record now of actually delivering what we intended to do. We are obviously pushing out research. We've got a large number of articles going out. We've had quite a number of events in the last year or so. We've reached nearly 17 million real live consumers with some of the insights that we've been developing through the TFI. And our research community is now up to 900 members. Obviously varying levels of involvement, but I think what's particularly notable is that we now have research collaborations with 39 institutions, and 8 of which are actually using ING data, and that's great credit to Stefan over here for making a breakthrough with the Dutch Privacy Board in ING to get access to client data. This is very essential.
Can you hear me now? Yeah, okay. Sorry, I didn't realize you couldn't hear me. So we have obviously been making progress on the innovation front as well. We have, with our corporate partners, Dell, Deloitte, and now Amazon Web Services, been supporting 12 different fintech startups in our growth track. So basically, we are trying to get thought leadership and innovation fired up through the TFI. Interference here? Maybe a talk from here might be safer. Sorry to hide behind the podium. So anyway, I won't go through all of this roadmap, but I think it's best to look forward because essentially what we're all about now is really trying to scale up the impact of what we do. So it's not just about thought leadership and raising awareness of the insights that we're developing, is actually making tangible impact in the real world by applying innovations. And one of the new forms of supporting innovation is through trying to develop actually new businesses. So we don't have too grandiose ambitions on this at the outset, but we certainly have very much a purpose-driven approach to this, which is indeed to help people make better decisions. So we're hoping to get some new businesses up in the air to actually put these things into action. And to that end, we are thinking of organising an event maybe early next year where we get the researchers together with the innovators, and I think have some workshops. And this is something that our research board has put forward, and I think this is a good idea. So watch this space. In the meantime, you may have seen the flyers out on the desk out there. If you didn't get one, I think there's probably still a few left. We have an outstanding call for research papers with a deadline of 6th of October. You see in the middle the list of topics that we're addressing. Obviously for tonight's event, I suppose number 3 is the most relevant. We're looking at, in this category, digital technologies, digital identity, which is now a hot topic in banking, and as is, of course, privacy. So, how does that fit into helping people with their money management? This is it's pretty challenging to put all of this together in a way that doesn't fall foul of privacy or security problems. So that, I think, is a very important theme for this year, but as you see, there are a number of other, I think, very interesting themes that have, I think, been rather under-researched in the past. Basically, 2 types of tracks here. One is obviously the smaller projects, which run for 6 months with funding of potentially up to 10,000, and then the longer-term projects up to 2 years with up to potentially 100,000 in funding. So please don't just put in bids for 100,000. If you can do it for cheaper, that helps us because, of course, we can fund more work that way. This is a bit of an eye test, so I'm not going to encourage you to read it all, but this just gives you a little bit of the background information about how we actually make decisions about how to allocate the research money, and it's an attempt to really get a mapping of the research activities in this domain. And so we've created this heat map, or what I call the 3D map. And the columns are basically the types of financial decisions. So as you can see, running through spending, borrowing, through to saving, investing, and insuring ultimately is a new category at the end that we've added. And the rows are basically looking at this at different levels, from obviously the macro context to the decision making that households are making, all the way through to the micro behavioral issues. But I think one relatively neglected area is the middle area, which I think is also particularly pertinent for tonight, which is the social context behind people's decisions. And we've already had some very interesting research put together to show that indeed social influences are critical in terms of people's financial behaviours. It's not just about individual biases. There are social influences that have a profound impact, and I think we've got some very interesting papers over the next couple of days that hit upon this as well. So this is the 3D map that we use. It's not something which is mechanistic. I mean, some things that are heavily researched, are important and difficult, but it is the case that there are a number of gaps in this map that we would like to fill out. So moving on more to tonight's event, I thought I'd just share a few thoughts about our work on technology and how it applies to banking. And for over 7 years now, we've been doing surveys of real consumers, asking them about their attitudes to their finances, their spending, their saving, their housing activities. But we've just published in the last few days an offshoot of our latest survey on digital banking with some quite interesting results. Basically, I think people are really feeling the benefit from digital banking, and it's, as you know, it's relatively new. It's really only taken off in the last decade, and but there's clearly some reticence on some of the newer innovations that are coming through. So at the moment there's a bit of reluctance to embrace investment advice through robo-advisors. It's a bit unfamiliar. People are a bit wary of that. And they're also a bit wary of voice interactions as well. Maybe that's got something to do with the fact that it's been dominated by the big tech, and they're under a little bit of a cloud in terms of privacy. But it gives you a bit of an indication of the current mood of consumers. But it's also clear that these things can change very quickly, because the adoption rate on some of these technologies has been extraordinarily fast. The other thing which is rather gratifying is what consumers say about the impact on their behaviour. And I think this is really worth reflecting upon, because this is something which is potentially of macro significance as well as micro significance. So, for example, a number of years ago we did some research asking people, do you have financial goals? And a surprising proportion of people said no. We don't have financial goals. So the banks are wandering around saying, well, we want to empower you. Well, people aren't looking to be empowered. They don't have any goals in the first place. So that's the first hurdle, and actually helping people to think about their money and define their own goals is an issue. The good news is that, as you can see from the top there, the top bar, that actually people are saying that having digital banking is helping them to define their goals. So the money management tools, although they are at the moment relatively unsophisticated, are already having an impact on people's goal setting, but also I think on their ability to manage their money. So this is good news. And you can see also the second bar there that people are now checking their account balance a lot more frequently. And when you think about it, given that the bulk of the population are borderline broke, this is actually pretty transformative. If you no longer have to wait for a paper statement in the mail, which is 3 days out of date when it lands on the doormat, you can get your phone out and see if you have any money to pay for whatever it is you're trying to buy. So, it's a very simple thing, but it has, I think, potentially profound consequences. We can do a lot better than this, and obviously there's a lot of fintechs who are working on money management tools. So, just a couple of remarks before I hand over. I just wanted to put this into context in terms of the kind of discussions that we have about the relationship between banks and big tech in particular. This chart is really, at least in part, inspired by the thinking of marketeers in terms of decision journeys or consumer journeys. In other words, it's not just about the transaction, it's about the full journey from search through to consumption. And mention the word search, and of course you immediately think of Google. Of course, people are also searching on Amazon when it comes to purchases, but what's noticeable is the influence of the big tech in the way that we make decisions these days. On the right-hand side, you see another dimension of this, which is social media and social interaction. Obviously, Facebook being the dominant player with its variety of brands now and flavors of social interaction, but they are extremely influential now, not just in terms of targeted advertising, but also in terms of the kind of interactions that happen within social communities, influencing one another in terms of how people spend and save their money. Now, I mentioned spending and saving. I had to stretch to put saving on this chart because, of course, when you look at a lot of the brands on that chart, certainly at the top and the bottom, they're in the business of selling stuff, or services for that matter. They're very keen to sell you things. Now, this is another opportunity for banks because the incentive structure for banks isn't just about selling stuff. We actually are also in the savings business, and also we're in the lending business, and we don't want people to go broke. So my view is that the banks need to reinvent themselves as decision-making services companies. Transacting is going to be commoditized. If you think about the payments business where the tech companies are moving in a big way, the margins this are going to be wafer thin. This is going to be the retail equivalent of foreign exchange. You won't be able to make money in that business in the future. So you're going to have to do something different, which is adding value to people's decisions. And this isn't just about price search or even quality search. It's actually understanding what people's goals are, which is why you need the soft data around people's motivations. What is it that's influencing people's behaviors? So that's one of the reasons why we are really very keen to have multidisciplinary approaches to the research that we're conducting. So, just to round off, can the banks fight back against big tech? Well, obviously the banks like to think that they are protected by a regulatory moat. To a certain extent, that is true. But guess what? The big tech are now even asking to be regulated. I mean, Facebook did so famously recently. So I think it also hasn't stopped them encroaching into the finance business, as we'll be hearing in more detail in a moment. Of course, banks also have expertise in risk management. There is a key function in banking which is often overlooked, which is maturity transformation. This is not something that the big techs, by and large, have spent a lot of time thinking about. They are moving into the lending business in terms of supply chain finance, but they're not in the business of making 30-year loans, just yet, anyway. The third point is that there are some data advantages that the banks have. They have transactional data. They have a very interesting variable which is not readily accessible even by LinkedIn, which is income. When you think about it, that is actually a pretty important statistic. I mean, Facebook can have a guess at how much money you're earning, but they don't know, nor does LinkedIn. So that's a very important advantage that banks have really got to think about capitalizing on. And of course, the other thing, as I mentioned, we are probably going to see some profound changes in the regulation of the tech companies. And I think one of the things that could be a complete game changer is the equivalent of PSD2, Payment Service Directive 2. I don't know if you're all familiar with that, which is basically open banking. Banks have got to share their data. What would happen if we had social data Services Directive 2, SD2. In other words, we could actually access social data so that rather than having to beg Facebook for the social data, we could get it with the client's permission, of course, and use it to help people with their decision making. So there could be some major changes in data regulation. And the crucial thing, which of course is very topical at the moment, is trust. If you think of that, the techlash, a lot of this is about mistrust around particularly the social media companies like Facebook and Twitter. Now, the banks, they may have done all sorts of things wrong and they have damaged the trust in themselves, but one thing that people still trust the banks with is financial data. I mean, after all, it is often quite a pain to get into your banking app with all the levels of security. So there's a level of trust there which is absent, I think, for many of the big tech companies, and that's something to be built upon, that if banks could also become something of a data guardian, curating not just your financial data but other forms of data, that would be a tremendous opportunity to allow the banks to actually sit on top, if you like, of the big tech companies, curating and managing the release of data. Okay, well, with that thought, I'll just conclude. I think just to say one final thing about the Think Forward initiative, I mean, looking ahead, I think matching is going to be a big theme for us. I mean, matching different disciplines, as I've already indicated, so it's not just having the economists in the room. We want the psychologists and the sociologists and other disciplines to be involved in these projects, but also matching the researchers with the innovation people, and as I mentioned, we're looking to institutionalize that with more interactions with the innovation side of the Think Forward initiative. So I'll leave it there. Thank you very much, and perhaps can hand it over to the panel. Thank you very much.
All right. Welcome, everyone. Before we get started, I just wanted to acknowledge the role of Andreas Fuster in putting together this panel. And anything good that you see is his doing, and anything bad that you see is my doing. I also wanted to acknowledge Tarun Ramodarai, finance professor at Imperial. He may or may not be responsible for anything bad that happens here. We'll leave it at that. So what we thought was, given the expertise of the people on the panel, we'll start with a few opening remarks from each of the panelists on things that they are seeing in this area from their perspective. So as everybody knows, Leonardo works at the Bank for International Settlements. So we are hoping that he'll tell us a little bit about the advances when it comes to household financial markets pertaining to big techs and fintechs, especially given that BIS came up with a recent annual report where that was the emphasis, and he had co-authored that report. Then we'll move to Devie and hope that she can tell us about what she sees as consumer finance developments in terms of products, services, and other things that big tech and fintechs are coming and sort of working with banks. And then finally, Tommaso, given his role very recently thinking about competition and data and privacy, if he could tell us a little bit about how he's seeing the role of big techs and fintechs in shaping how we have thought about these issues. So I think initially we could probably have a few minutes from each of you on these issues. And then we'll open it up for a few questions from me. I'll try to instigate you to say some controversial things. And then we'll open up for questions from the audience. Okay, so that's the plan. All right, Leonardo, thank you.
Okay, so I'll move directly.
Yeah. So I think Leonardo has a few slides just to help us guide our thinking about some of the latest trends, because, like I said, at BIS, they came up with a recent report where they produced some very interesting statistics on what we are seeing when it comes to big techs and fintechs. I actually encourage everyone to take a look at that report. It's really, really good.
Could you help me? Sorry. Okay. Is there
that's what you explained.
So first of all, I'd like to thank you, the organizer, for inviting me to this panel. I am Leonardo Gambacorta. I am the head of the Innovation and Digital Economy Unit at the BIS. I was previously a research advisor and head of the Monetary Policy Unit at the BIS, and I spent the initial part of my career at the Bank of Italy. So today I will kick off my discussion with a few slides on big tech in finance. I will give you some slides, facts of these large technological firms, such as Google, Amazon, Facebook, Tencent, that Alibaba, that have taken some inroads into finance. These are very large firms. Just to have an idea, the level of market capitalization is larger than the one of the GSIBs, the large financial institution. And they have started to use their network externalities, this feedback loop they have, data, network externalities activity, to venture into finance. So obviously, these are my own thoughts. I mean, the usual disclaimer applies. I'll try to just show you a few results that summarize the work that we have done at the Bank for International Settlements in the last annual economic report. So the first fact I want to show you is that financial services are only a small part of big tech business. So if you, for example, have a look at this left-hand graph, you can see that only 11% of the big tech revenues come from financial services, while the core business of big tech is still information technology and consulting, is, for example, cloud computing and data analytics, that they account for around 46% of big tech revenue. On the right-hand side, there is the regional distribution of big tech subsidiaries. And from here, you can see that while big tech serve users globally, their operations are mainly located in North America and in Asia. Their move to financial services have been most extensive in China, but as you can see from the right-hand panel, they have been expanding rapidly also in emerging market economies in Southeast Asia, in East Africa, and in Latin America. So a second stylized fact to report is that the development of big tech in financial services followed a precise pattern. So basically, they started from payment services that were the first financial service that the big tech offered. So examples that we have in mind are, for example, Alipay from Alibaba, PayPal, eBay, that are financial services that are fully integrated in their e-commerce platform. Interestingly, the development of big tech payment service is higher where the development of credit card is less diffused, and it could count on the fact that there is a large fraction of the population with a bank account. This also helps to explain from the first chart the large volume of big tech payment in China, where, for example, the big tech payment volumes are 16% of GDP. So after payment service, big tech started to offer, via their own apps, also wealth management products, such as money market fund and insurance products. So here just I report a few interesting facts regarding Yuobao. Yuobao is, for those of you that you don't know, is the largest money market fund in the world, and it's basically from the offer by the Alipay group. So on the left-hand side, you have the asset composition of Yuobao, and you can see that a large portion, more than 60% of the assets, are invested in the bank's deposit. While on the right-hand side, you can see that around half of the maturity of the asset is less than 30 days. So this just to make a point that there is a strict relation between big tech and banks, but these relations are very complex. And for example, in this case, you can imagine a run on a money market fund may have also negative impact on bank funding. So this is my last slide on facts, and it is about big tech credit. So as a final step in this process, from payments to the money market funds and the insurance products, the big tech, they started to sell their loans. But so far, the development of big tech credit is still fairly limited. You can think about that globally, the overall amount of fintech credit, that includes also big tech credit, is 0.5% of the total outstanding amount of credit. And even in countries that are at the vanguard, for example in China, this is only 3%. So it's still very limited. Interestingly, this big tech credit is very different. Some studies that we have conducted at the BIS show that big tech credit is negatively correlated with financial development, as the graph on the left shows. You have the bank purchase per adults and the logarithm of big tech credit ratio on the vertical side. But also other interesting facts that, for example, big tech credit is mostly developed in those jurisdictions that have less restrictive regulation. On the characteristics of the credit, we did some studies regarding how these credit correlate with the business and the financial cycle. And one interesting fact is that it does not correlate too much, actually is not significant, the correlation with asset price. So in this right-hand panel, there is a comparison between the correlation of bank lending to firms with collateral in China, that is approximately 0.9, not differently from 1. And then this drops to 0.5 when you have bank lending to small firms, and practically is not statistically different from 0 when you have credit to small firms in China provided by my bank, that is a big tech firm. All this obviously has implication for the monetary transmission mechanism. I stop here. Let me highlight in this study, just to make a little bit of publicity, some studies that we have conducted at the BIS. I'm looking forward to discuss these topics with the other panelists. Thanks.
Thanks, Leonardo. We'll next move to Devie.
Thank you. My name is Devie Mohan. I run a fintech research company called Burnmark. We are a startup. We think like a startup, behave like one. I may be the only researcher in the room without a PhD, so please take everything I say with a pinch of salt. I also have several other day jobs. So one of the things I have done is involved with TFI since about 2015, 2016, and I've been with TFI in various roles. One of the most fun projects I had was last year we ran a startup in TFI as part of an accelerator program based on one of the research projects that someone did in the program. So it was really taking research and converting it into a commercial reality. I'll tell you more about how it went separately and privately, but it was a fascinating experience to see how social media data, as we heard earlier, can be used to make financial decisions. I have several other jobs. I won't go into it. I do a lot of teaching and writing, etc., etc. Now, one of the things I've been asked to speak about is how we see the fintech market and the products and services. And our view is that if the market analysis that we do is very much bottom-up, which means that we look at startups, how many POCs they are doing with banks, how much revenues and customers they are acquiring, and we size the market that way. So we do it in a very non-traditional way, and the view is pretty much around how the startups behave in the market. It doesn't mean we don't have a view of what big techs do and banks do, because ultimately it's a very, very closed ecosystem with severe impact on each other, especially in Europe and US. But what we find increasingly is that in geographies outside Europe, especially in Africa, in Latin America, and Asia, the startup ecosystem is having scale and traction on its own without actually being impacted significantly by banking and regulatory forces. For example, M-Pesa in Kenya is a very old example of this. We have several other players in India, for example, Paytm, who has about 53 million customers. And all of these players have achieved scale without significant governmental or banking influence. So it's a very interesting way of looking at what products and services are emerging in the market, and I'm hoping to give you a bit of view on that. So I want to give you a couple of case studies to tell you my point of view in this. One of the case studies I want to talk to you is something you may be familiar with. Most of you are from Europe, which is the challenger banking industry in the UK. we have about 53 new challenger banks in the UK, and by new I mean launched in the last 4 years. 53 challenger banks, we have about 26 of them going through the licensing process as we speak. It's a classic example of regulatory pressure easing and new startups being able to launch into a completely new field and focus on consumer behavior. Changing consumer behavior if needed to in terms of the banking experience, and including more and more groups into the fold. For example, millennials, students, refugees, etc. Well, it's gone well over the last 4 years, but what we have seen is we've conducted lots of surveys on what challenger banks are doing and how the users feel about it. We found that 74% of consumers are trying out challenger banks rather than treating them as a primary bank account. We found that only 3% of the consumers shifted from a traditional bank to a challenger bank in a year. And these numbers kind of tell us that even cost is not a driving factor. Only 3.2%, I think, told us that the cost, free accounts being offered by challenger banks, was an incentive for them to shift. So it's not really working in terms of capturing new customers away from traditional banks in this space. And then we start wondering, what are 53 challenger banks actually doing? And they all have a similar product portfolio in that almost all of them have current accounts, 54% have similar lending products with similar lending fees and costs, and 52% have similar savings accounts with similar rates. So they're all doing similar things. They're all targeting similar customer segments. So it leads us to kind of wonder, where is the space going? I don't know the answer to that, but I think one of the ways we have to go is by consolidating with each other, target new segments which are underserved and which is already happening with Tide and SME banking, for example, Moniz, and targeting refugees from Syria and Iraq and offering credit scoring based on their past experience rather than where they are in the UK. So all of this is happening, but there is a problem in terms of competition, similarity of products, and innovation kind of flattening out as we speak in the challenger banking industry in the UK. So consolidation may be the way we see this industry going forward, with banks acquiring them, fintechs working with each other, or other parties, PE firms acquiring these challenger banks. Now, this is an example of a mature market in a way, because we have a large number of players actually in this space. So one of the other case studies I wanted to touch upon is India and WhatsApp. It's quite interesting because in the UK, we are so used to having so many different apps on our mobile phones for every use. On average, we have about 20 to 25 apps for someone aged 18 to 35. And what we feel in the UK especially is, if we have more apps, we are cooler, right? And the more options we have for ordering food, we are so cool. We have Just Eat, we have Deliveroo, we have Uber Eats, but they all order from the same restaurants. So we have choice, or we have the illusion of choice in the UK. And how do people order food in India, for example? I come from a small town in India. I was watching my sister order food, and there are no apps to order food in India like we have in the UK. And what she did, I think that some of you are disagreeing, there are some, but what she did was use WhatsApp to order food. And how she did that was tap into the WhatsApp ecosystem. She goes on these groups and communities of some kind and asks the question, who is able to deliver me a chicken curry by 8 p.m.? and then someone responds back with a price, and then she types in the address, and there's a Paytm transfer of virtual money from one wallet to the other, and the food is home in about 15 minutes, and the whole ordering probably took her less than 2 minutes, and no credit cards involved, no cash involved, no physical transaction at all. So it led me to wonder, I mean, is the UK really ahead of the rest of the world? Because we claim credit cards to be cashless, but is it really cashless? It's still a physical device. Whereas the power of WhatsApp, the power of Facebook is tremendous. We have about 26 million users of Just Eat app, and we have about 400 million users of WhatsApp in India, about 1.6 billion worldwide. So if you look at scale and the ability to do multiple things within an ecosystem, I think we are far behind, and probably time to look outside Europe for ideas and answers. So that's my second case study on what could be done better in Europe. I mean, both of them are cases of what could be done better. The other thing I was asked to talk about was the impact of big tech. Now, we look at big tech on the periphery of whether they will come into finance or not. Otherwise, we are not interested. But as more and more surveys are done in this market, we find that the students, for example, we do a lot of survey in the 15 to 18 age groups, and they tell us that they hate Facebook. But increasingly, they're telling us that they hate Instagram. Fine. I mean, there are quite a few 30-year-olds on Instagram now. So the kids find it less cool. And they're starting to hate Snapchat. Now, I thought Snapchat was the coolest, youngest thing around, and it was a shock to me when they said, we hate Snapchat. Like, what is it that you guys are doing? So then they said TikTok. Some of you may have heard it. YouNow, it's a new social media platform. Whisper is the replacement of Snapchat. And Yubo is somewhere you can matchmake with other friends by swiping, just like Tinder, for 12 to 13-year-olds. So, so in that scary world, I think one of the things I'm realizing more and more is we can plan ahead and think the big techs are going to do this and big techs are going to be in banking. Oh, it's great. But what if the youngsters are not going to use that platform anymore? And I advise this to every bank I work with and say, if you're trying to be like a Facebook, please stop trying, because you're going to be dead in the next 5 years if that's the case. I think the ability to innovate quickly and adopt to new platforms and new ecosystems, I think that's what banks need to work on building in-house. And hopefully, that's where I know that ING Bank is headed that way, because I've worked with them on the TFI project, and it's pretty great. I think the ability to be flexible is what's missing. And I wouldn't worry about big tech so much because of that reason, because the 15 to 18-year-olds are telling us a different story. They don't like apps anymore. They don't trust data being given to unknown parties, and they don't enjoy Facebook and Snapchat and platforms like Amazon, perhaps, in the next few years. So what comes next is hard to predict, is my conclusion on the topic. Thank you.
Tommaso, thank you.
Thank you very much for having me on this interesting panel. And I'll introduce myself. I'm Tommaso Valletti. I'm not an expert in household finance, so apologies for that. So I'm very happy to listen to the conference and to your presentations. I will be learning a lot. I'm actually, in my research interest is actually industrial organization, but in the last 3 years I was on academic leave, and I was the chief economist of the European Commission with Vestager, so we were dealing with the competition cases of our time. So this has been a naturally interesting policy experience. So that if we go for dinner, I can give you a lot of anecdotes. So we dealt specifically, as you may know, with 3 Google cases. Android was the biggest one, but also AdSense, and also the shopping case, which was the first one. We opened proceedings with Facebook, with Amazon, still investigations in the financial sector. We did, I don't know, interchange fees regulation of Visa and MasterCard. Apple Pay, as I said, is subject to investigation. We did cartels of incumbent banks in the Netherlands and in Poland because they didn't want to give access to entrance in violation of PSD2, but also with more foreclosure details that we were assessing. So it's a portfolio of cases beyond also the financial services, which gave me a view about what some of these platforms are doing. And I guess I'm here also to share some of my thoughts. And there was also this discussion. We were a competition enforcer of this distinction between competition policy versus consumer protection when it comes to data and privacy. So we had an intense discussion whether, I mean, if you ask an expert 3-4 years ago, they would have said these are two different tools. Consumer protection is one thing, competition is another thing. Having seen a little bit how these markets work, I've changed my view over time. So I think they are really interlinked. It's difficult to think about privacy issues without thinking about competition as well. So if you're interested, I will tell you more. But my initial remarks are on following what is the topic for tonight on the big tech and the fintechs. I have different views about them. Roughly speaking, I believe in competition, so competition is a good thing. Competition is to be welcome. Technological advances are out there. If we want to believe what Tommaso Valletti has been telling us for a few years now, the cost of financial intermediation has been constant at 2%. So maybe there has been technological progress, but consumers have not benefited from it yet. So the question was not why we see, but why now. So it's a very welcome technological change that we're witnessing, and this is to be cherished. The differences, though, I see is that I see traditional banking as an attempt to bundle a few services around the consumer, and obviously traditional banks had a very customer-centric relationship. And some of the fintechs started unbundling this, so they can select some profitable segments, they can skim the cream, and so as you know, they've been very efficient on some payment systems, they've been very efficient on with some foreign transactions, they've been very efficient when it comes to some mortgages. So there's lots of specialization, there's lots of entry. You want to have a sort of regulation which is proportionate to the type of services that they are offering, but this is good. But there are also weaknesses there because they don't have brand recognition, they don't have an installed customer base, they don't have those things, so they don't have capital behind them. So I'm talking about the bigger picture. You can always find some counterexamples, but I'm trying to give you a broad brush. So the fintech are vulnerable in this sense, and then the most efficient will come out, but they are still in a more standard business model, which will benefit the tech-savvy people. I don't know if it is a 15, 18, probably it's too early, but it is the people that can master the new technologies, they know where to look for, etc. So, but which will, by the way, create more and more of a dual system in the banking sector between. So the cross subsidies we were using in the past will not be sustainable any longer, and so this is perhaps more of a social problem. When it comes to big, so I have a positive view about the fintech. Instead, I have it's my personal views that I have, but I have come up with a very negative views about the big tech. So I kind of disagree a little bit with Devie. So I have kids, so obviously the future is our kids, but currently Facebook has 2.4 billion customers, and no one else. So there is no Whisper, there is no one else that can match with that. So we have to think about what they're doing with these 2.4 billion customers, because this is unprecedented market power, same thing with Google, etc. So what these companies are doing, and these companies, they do have the capital, they do have the brand recognition, they do have the customer relationship on other services, but still they have it, so they can enter in a completely different way, and we have a whole history, especially with a Google, of time products. So it's the opposite of the fintech. The fintech are trying to unbundle bits and pieces, and instead the business model of the big tech is to re-establish a different type of bundling. And the differences there are in the economics. The main product, enjoys network effects because of social network, because of efficiencies in search. This is really where market size matters, per se, on the primary product. But then they try to leverage and think of Android. The real money was from ads, and the mobile market was developing in a massive way. And what Google did was to offer the OEMs, the mobile phone manufacturers, Samsung, they would say, look, get my operation system for free. However, you must take also my search engine and my browser. Okay, so and by doing so, they would protect the money-making machine, which is search, paid search, the ads, and that was anti-competitive according to us. Of course, the case is under appeal, and we will see what the courts say. But this kind of practices is something that perhaps also a financial community needs to think a little bit, because you have to see the monetization, follow the money. You're used to that, but follow the business model. And the business models of the big techs are multi-sided markets, but essentially they are trying to have some people call them attention brokers. So they try to learn about us and capture our attention and create bottlenecks. And once a bottleneck is created, they're going to be the gatekeeper of the bottleneck. And then they sell access to the bottleneck. So Facebook, Google are different, but the business model is pay for display. Okay, once you have controlled the access to your screen, if you want someone else to have access to your screen, you have to pay. Shopping, there is an auction which is being made in Facebook. If you want to do display ads, that's going to happen. So I can easily imagine a situation where you're looking for a car, you're looking for a good, you're using some product of Google, and they will help you to buy the product. They will ask you if you need a loan. We can help you in that way. It's going to be bundled together. And then those were actually so you have those that can Google can auction then to the suppliers of loans to those which are paying the highest fee to display. So something that in the financial market you try for a long time to see where they're recommending products and cutting links is going to be reestablished once again. The one that pays the most, is it the most efficient? We don't know. It's just the one which pays the highest price for the auction that Google is running in that moment. So it is efficient, but there are going to be some efficiency gains in the short run that, of course, are going to be announced to everybody, and people, we like to save on transaction costs, which is a good thing, but the potential for monopolization. So we have to think really in the longer run. I know it's difficult to predict all this, but we also have enough experience from other markets to see where this is potentially pretty dangerous. Thanks.
All right. Thank you to the panelists. As you can see, we have a pretty diverse set of panelists here. My guess is that if we had done a panel like this a decade ago, we wouldn't have had such diverse set of panelists thinking about regulation, thinking about competition, thinking about access to consumers, especially this being a household finance conference. We probably wouldn't be talking about these things. But given what you've sort of mentioned, let me throw some controversy here so that we can get some honest opinion from all of you, rather than prepared opinion. What's the problem with having big tech and fintech? Because we sort of talk about them as they are different beasts, and there's potentially a bad thing looming out there. What if this was just, a skeptic could say that this is just banks are worried. Banks have been working in this for a long time. They had their rents, and now all that is happening is, from the banker's perspective, that they are facing competition. Not surprisingly, they are worried. They've had their share of rents, and big tech and fintechs are able to service different segments in a much more efficient manner. So that's a great thing from consumer perspective. And it's bad for banks, but too bad. They got to figure out how to work around this. But from the consumer perspective, it's a great thing. So do you all agree with this, or do you think there are things that I'm missing in this simple story, that this is just more competition? Let 1,000 flowers bloom. What's the problem? So anyone can answer this in any sequence.
So I think that we have to distinguish between big tech and fintech first, because first of all, I think banks are more worried about big tech. the potential benefit and the potential cost of big tech in finance, they all derive from the same thing. That is this DNA. So it's a data, network, externalities, and activity. So let me just make you the example of the lending market, say loans. So if you think about the provision of loans, we have already some evidence that, for example, big tech provision is a good story in terms of screening because of the use of machine learning plus the big data, that model that typically outperform the credit bureau model. And it's also a positive story about financial inclusion, that they tend to serve those parts of the population that are typically unbanked. Again, efficiency and positive aspects are related to the monitoring collateral, because these loans are typically not collateralized. They basically transform the data, they use data as collateral. They have data and they can understand the firm's type by using the data instead of the collateral. But the data network externality has on the other side of the coin, that is the potential cost in terms of market power and misuse of data. So that I would distinguish the two components. So first, we can imagine that big tech, they can certainly become a dominant player, consolidate their position, and raise a barrier to entry. So while in the typical financial stability efficiency trade-off, the textbook that we studied a few years ago, we had this idea that entry brings more competition and efficiency. This could be maybe in the transition, but in the steady state, it could be that big tech could become a dominant player, favor the distribution of their product, and basically exclude the other. And there is another aspect that is related to the misuse of data. And here we can think about potential problems related to price discrimination. So big tech are very smart, so they can price discriminate products and get the surplus. And then they can use data in a way that is not appropriate. For example, using the machine learning algorithm, they can exclude some part of the population that otherwise would be socially desirable to give products or to cause some form of discrimination. So it's not so easy to distinguish. So from a welfare point of view, public policy perspective, this really depends on society preference. At the end, we have ideally to maximize welfare, increasing efficiency, containing the cost. But when then you think about regulation, you have here three kind of agent at the national level. Is a prudential regulation, competition authority, and data protection authority, and then coordination internationally. And internationally, there are countries that have different preferences. Imagine a small economy, emerging market economy, have a lot of preference for financial inclusion, while maybe a country that is advanced are more weight on data privacy. So, difficult question.
I think that's a fantastic question, and I'm glad it came out, because if we had spoken in a panel about fintech 2 years ago, everyone would be saying fintech is great, it's brilliant, it's the best thing that has happened ever to the financial service industry. The fact that we are here analyzing the negatives and talking about what it needs to do to improve, I think it's a fantastic sign. It shows that it's a maturing market. So I'm glad that we are bringing in some negativity to big techs and fintech. It doesn't mean it's all negative. I think one of the issues with the whole industry is that customer acquisition has become a major problem for startups. Ultimately, the valuation, the survival is heavily dependent on the number of customers they have, and startups are going to all extent trying to get those customers, get the numbers ahead of other competition in the market. Now, that is a tricky thing to have, because now in one of our surveys, we found 56% of consumers in the UK, in the whole of the UK, have free accounts given away by Monzo, Revolut, and Starling Bank. It's a scary thing for me because they are getting customers in. Some of them are being paid to open new bank accounts. Now, that's a worrying development. I mean, customer acquisition should not be the be-all and end-all of banking. That's fundamentally a problem. The other issue is that rebundling is happening within the fintech startup scene as well. So most of these bigger challenger banks are now rebundling, just as Tommaso has said, different products and bringing it into one umbrella and trying to compete directly with the larger players. Now, that could be worrying again because the kind of innovation, the amount of money we have spent on R&D of interesting new products now has kind of flattened because of this. The focus is very much on rebundling, having the largest number of products, largest number of customers. Now, that's another problem, the level of innovation going down. And the third problem, I think, is that startups tend to focus heavily on the most lucrative markets. So who is actually thinking about financial inclusion? Are they getting enough funding from investors? So all of those kind of questions on are they targeting the right groups in the right places are coming in as well. But ultimately, competition is great. I agree with all my other panelists on that. We have seen tremendous amount of investment going into banking industry, $850 million invested in challenger banks. We have banks investing heavily in new products and services. So that's a great thing. It's just like we saw with the space program from NASA. The best thing to come out of the NASA space program was microwave ovens. So all of this investment we are putting into fintech startups will probably create one tangible, memorable thing that will have a lasting impact in another 100 years, and that'll be great. But I think it will be invisible over time, it will be consolidated, and it will be hard to separate banks and fintechs and big techs in the future, is my view on that.
I'm going to say also a couple of words on this. So we all started from the premise that competition is good, and this is something most of us would agree with. But so what's the problem? The problem, and so it's a bunch of economists here. So these are industries with lots of externalities, business models, and I'm talking about big tech, which is based on purpose on some prices giving out for free, okay, on purpose, because Facebook, it could be a service for a subscription, but they didn't want to for a reason, and similar for search, etc. So they need to monetize someone else. So when you have externalities, markets fail. So it's as simple as that. So this ought to be an industry that we have an interest as economists, because they wouldn't expect competition necessarily to support. This is an industry where perhaps some appropriate regulation could make things better. So if I can, so it's not a surprise that we are discussing about it. This is not producing bread. Okay, this is an industry with market power, concentration, high margin, externalities, behavioral biases, you name it. You put together some of these things we study, and you get some of the digital platforms. The second point that we can also think about, precisely when you have consumers which tend to have one social network, one search engine, one electronic marketplace, etc. So you have some of us which single home, and then you want these guys to be contacted by someone else which are going to be multi-homing. These are markets where you have extremely skewed prices. Some prices may be zero, but not because these guys are good, because this is exactly what you need then to screw up someone else somewhere else. So there can be problems. In the cases I've seen, it was, I don't know, in the advertising markets, this is the side which need to pay whatever it takes to contact Facebook or the Google, and it could be in AdSense, it were the publishers, and you can go on. In the hypothetical example I gave you earlier, if Google, as I said, auction off for fees, whoever thinks so it's a bit delicate there. So it's not surprising that we're talking about it. There is then the issue of data. Again, this is more conjectural for me because I don't know exactly, but this is where really there could be you will tell me, at the basis of many financial institution is access to information, to soft information. So this is the whole basis. And banks have it somehow, so they have an advantage. When it comes to Google, Facebook, and perhaps Amazon, I don't know, but these are two guys that, it's not just the sheer size of the data they have, but the ability to cross-link different things that implies that in the limit for some customers, even you can have perfect information. So all the asymmetric information you could have had before, it's lost, which means, so people think this is efficient, but I'm not exactly sure, because we know that price discrimination in a competitive market is potentially great, because it means there is competition market by market, and everything goes to the consumer. But if instead, if you have huge asymmetries, this is the recipe for extracting actually the highest possible surplus from those customers which are valuable, and then those which are crap are left somewhere else. So it goes to the opposite of the inclusion or this narrative that we are talking about. Developing countries are different. If we're talking about M-Pesa, about these things, we are instead in developed countries where people have bank accounts, because we're not trying to bank the unbanked. So I'm a bit more skeptical. So this, I understand this is like a sort of, when it could be an efficiency offense in a sense even here, but there are some implications which are not so straightforward. So these are my different reactions as why is this different from simply saying these guys are better. We have seen, by the way, lots of entry and disruption of these guys when it comes to travel agencies, when it comes to books, when it comes to all this, and some of this has been good. But when we see, and again, it's not a general statement at all. I'm not a Luddite, I don't have a phobia for technology whatsoever or for platform, on the contrary. But when this comes at some stage with big market power, I have seen Google or Facebook not allowing some particular application to be developed because Facebook had its own WhatsApp, which was competing, and Instagram, which was competing with those applications, and they started doing foreclosure strategies. These are the cases which I've seen, okay? So this is the anti-competitive potential which comes with market power.
All right. So thanks everyone. Let me continue on this same theme a little bit based on what I just heard. So one way to think about this is that if we think about households and trying to offer them the right products to help them save for retirement or smooth their consumption and so on, there is one segment in the household space which basically banks were not touching, right? Like, for example, in the US, you had people who were banked, and then there is payday loans. There's nothing in between. Pretty much has been the case for a long time. And for those households, if fintechs come in and are able to offer some ways of, helping them smooth their consumption at lower rates, that seems like a great thing. I don't see the issues with that necessarily, even if they are using some data which might be proprietary. At the end of the day, banks were also using data to offer loans for a long time. We never worried about banks using the data in an inappropriate fashion. Maybe we think banks are more honest than big techs and fintechs. I don't know. I want to understand from you all. Then comes the segment in households who already have financial products, have some credit history. And there, what I'm hearing from you all is that, look, we have these machine learning, AI, all these techniques. Essentially, these things are complex, non-linear way of pricing things, which help us price discriminate. And maybe there is scope that if we price discriminate, we might leverage on some biases and extract consumer surplus rather than increase consumer surplus, at least for some segments. Now, there are firms out there which do this, which are doing cream skimming. There are many examples of fintech firms. Maybe big techs are also going to do it. But the question that I have for you all is, how much of this is really happening, or have you seen, versus catering to the household segment where there is a big need, and actually a lot of competition in that space is a great thing. So maybe we are overblowing what these big techs might be able to do and extract surplus right now, given how little that might be, versus the big benefit that is out there, because banks never touch this huge, may not be unbanked necessarily, just maybe banked, but not enough financial products. So any views on this? And again, you can go in any sequence.
I'll start.
Yeah.
So one of the biggest revelations that I had in recent times was precisely because some of these questions are ultimately so interesting for economists, and they are empirical questions. They are empirical. And I said, okay, these are, if I think of Amazon, Google, Facebook, Microsoft, these are, you know, the top 5 companies in the world by market capitalization. They've been growing like mad in the past 10 to 15 years. They are sitting on a trove of data which is unprecedented. So this must have attracted our attentions as academic economists driving towards fantastic publication. Of course, my lenses are through competition policy, okay? So maybe I'm totally ignorant. So I went nighttime, because at the commission you run cases, you don't do research. I went just to do, but you know, for fun. I mean, that's how I enjoy myself. I went to, you know, I know, as a cutoff point is totally arbitrary, but just wanted to see, last 5 years, top 5 journals in economics, how many articles have been published with primary data from Facebook, Google, Amazon, Microsoft, so, and Apple also I included, and the answer is 1. Okay? And the answer is 1. There have been thousands of articles being published, and it's 1 with some IP data that Google gave via Halvarian at some stage. So the question was vaguely related to competition. So the answer is 1. So that's a big problem. That's a big problem. We don't know enough because these companies, they close themselves on purpose. I tweeted because I decided to have a tweet nighttime, and when I tweeted it, then I received emails, private emails from researchers at Amazon, at Google. These are guys who got a PhD from Berkeley, Stanford, etc., etc., etc. Say, when I joined, I thought I could do research, but then it was clear that yes, I would get a good salary, but then they said, no way you can ever do research again, which means there is no revolving doors between economists and those companies. There is no data which has been released for academic research. So that was a shock to me at least, maybe, but it was a bit of a shock that we're lagging behind also because on purpose. So I even said that there has been a whole generation of the smartest guys who decided not to look into this question because you do empirical work and you know there is no data set, you move on to something else, okay? Because otherwise your career is going to be blocked. Because so it's not true in computer science, it's not true in other fields, but when it comes to economics, I/O, policy, etc. So this is another criticism that I have, which has also shaped my views about these companies. From the data I've seen from running, because when you are, of course, an enforcer, you can ask them to give you data that you cannot use for any publications. But from what I've seen, it is incredible how much inertia there is among consumers. So this idea that you give your data and then you know, you see through the whole process, it's a little bit of a legend, okay? It's a little bit of a legend. So it may be true for some very smart, we are not representative of anything. People like us in this room, we don't represent anything in the market, okay? Instead it says, okay, approve the terms of service, yes, say yes, which of course you're going to say yes, especially if there is a condition of market power, because there is no choice. So we go back to the same point. If there is choice available, you can make comparisons and you can make informed choices. But and more it's coming to be true. And again, I belong to the old generation. I do my searches on my desktop when there is a big screen and I see Google and I see the blue links, etc., etc. But if you do a research and you're young and you're using only a mobile phone, all the space is reserved to one result with a nice graphical interface, and that's about it. And that's where people stop. So in that world, yes, I do have concerns. Yes.
No, thank you. I don't have much to add, but I think you make a valid point around adding value to household finances and that space. And I think there's been a shift in the last 4 to 5 years away from trying to add value in that market, especially in the US. And one of the best ways, probably for one of the researchers to look at this question or hypothesis would be to look at the robo-advisory space. Because if you look at the evolution of robo-advisory, we started off having multiple robo-advisors with ETF-based products targeting this same market that you talked about, which had a gap, not served by high net worth individual kind of personal advice, not served by any kind of money management products. Now, this group was effectively brought in the US with the help of these robo-advisors. But what has happened in the last 1 year has most of these robo-advisors have disappeared, and they have been taken in by hybrid models launched by big investment firms like Charles Schwab and Wells Fargo and others. And they have actually been acquired or merged in, and the products have now effectively been tiered into two levels, in that the larger more complex investment decisions being done by humans, and the simpler ETF-based, simpler decision-making to normal households with very predictable people being done by robo-advisors, but within the same umbrella, offering both at the same time. I think that's an interesting shift, and I see it coming to Europe as well. But I think it would be great to see from a research point of view if that's true and how much impact that's making.
Let me have a little bit of an intermediate position that is maybe closer to what Amit said initially. There are a lot of areas in which big tech could be of help and improve the efficiency of financial services and improve our daily life. So I think that there is not a preclusion towards these large technological companies, but our attitude as economists, regulators, is to get out the best out of them and to limit potential costs and the distortion that would be created into the medium term. So I want just to point the case of China. So in China, I mean, I had some interaction with the Chinese experience, both for research but also for some trips I had. There are a lot of positive aspects. So if you think about the work that it has been done, even from the People's Bank of China, just to adjust the system and to adjust to this duopoly between Alipay and Tencent to provide services to the unbanked, you can see that it's a positive story. But still, there is a lot of attention because these are big players and they can dominate the market and then they could cause a problem. So there is a lot of attention from the regulatory side to correct a certain kind of behavior that could be discriminatory, that could be negative for consumers, and so on. So when we think about big tech in finance, I think that we have to be maybe skeptical but open to change. And this is the challenge for regulation, because now we have a new dimension that is the data. Data could mean something like increasing efficiency, but it's also data privacy. And at the end of the story, if you look at different experience countries, jurisdiction, it's always a matter of the preference of the society. If you are in a small country, emerging market with no financial development, the benefit of having technology applied for financial inclusion are massive. And maybe that you can close an eye on data privacy. Differently, in other countries in which we have already a lot of financial services, we do well, and basically we attach more to data privacy. So the role of the regulation is to cooperate and to reach minimum regulatory standards worldwide, and to let these three regulatory authorities, that is potential regulation, competition authority, and data privacy protection, to work together and to find the best solution.
All right. Let me sort of summarize what I heard. I think what you're saying is there is a lot of good things potentially out there, but there are risks as well. Especially when we think about developed economies where maybe unbanked is not such a big issue, and where the big techs really have become very, very big, maybe watching there and trying to understand how potential discrimination or exploiting of biases is happening is going to be useful. And then there are developing economies where banking system is not very developed, India, China, and so on, where it seems that a lot of these fintechs have gone ahead and done great things so far, and it may be useful to sort of apply some of the things we learn from developed economies to these economies as we go forward. So when I think about risks that big tech and fintech face, and I'm mainly thinking from the household side, I'm a bit worried that because there is so much discussion about all the things that can happen, and a lot is talked about in terms of dark things that might happen, isn't there a worry, and you can sort of correct me, is that we might be regulating too quick or doing things in a knee-jerk fashion which ends up hurting the consumers because we cut down on innovation. I mean, I'm sure you've heard of these arguments. You can react to that if you think that that's something that you worry about. And one more or two more risks that you see in this segment from your perspective. That's how we will conclude our discussion, and then I'll open it up for questions. So if you want to react to the fact that maybe we are regulating too fast or thinking about regulating too fast at the expense of potential innovation for households, and what are the two or one major risk you see in this space besides this?
Okay, so are we regulating too much or too little? Let me give some examples. So I mean, these big questions, and the answer is obviously it depends.
That's why they're
yeah, exactly. It depends. So I'm going to give you an example, a good example of bad regulation. In when we're talking about good entry that could have been blocked, M-Pesa. These were the mobile companies entering payments in developing countries, starting in Kenya and then Tanzania, and it worked all fine. Instead, in India, where the banking lobby was very powerful for years, and then they removed it. If you wanted to provide mobile payment services, you could do it only if your subscriber had a bank account. Okay, which is ironic if you want to bank the unbanked, because it was exactly so. Obviously, it wasn't taking up until they removed this, and then payments, mobile payments, became big in India too. So obviously, those kind of regulation are just there to insulate incumbents from the good competition that you. So those kind of things shouldn't happen. Now, when it comes, and again, I make a distinction to the big techs, these guys navigate the lack of regulations, okay? So think of Libra, they go to Switzerland, think of these examples. So, and it's many in the digital space. I mean, there was in the Luxembourg court the other day, all the taxes that Apple didn't pay, that the commission said that they should repay back. That's exactly what they do. To say that there is over-regulation of the big tech, I don't know. Okay, you come from Silicon Valley, so probably they tell you a lot of that. But I mean, in a normal world, these are companies which are not being. On the contrary, they navigate this gray area of GDPR is not yet clear what it means, etc. So it will be up to the courts. So we have to be also and to the academic community that you represent, and of course you want to do all the studies in a thorough way, but sometimes these things move very fast. So as a community, we have to come up with some provisional consensus, because otherwise these guys, which I've witnessed what they do, they would take whatever our one hand, the other hand, they say, okay, the academics don't know it, do more research, okay, come back to us in 10 years, and in the meantime, the world has changed. So if we are interested in policy, that's an if, maybe some of us may not, they don't want to do a different thing, but if we're interested in policies, some questions are out there now, and it's incumbent upon us to try to help.
Yeah, I think I'm a big fan of regulation, mainly because I don't want to see fintech startups fail. I don't want them to have data privacy or security issues, because that could have a domino effect on the industry. So for the sake of the industry, I would like to see regulation happening within fintech. But as you rightly pointed out, there's good regulation and bad regulation. I think what we need to do, especially in a room full of policymakers and researchers, is to understand what startups and technologies are available out there that we can actually use in our day-to-day lives. So as regulators, there are plenty of technologies. They're called SUPTech, supervisory tech. And it's a whole new segment that has emerged in the last couple of years that are catered towards supervisors and regulators who want to monitor markets, find out any risks for market manipulation, watch policy harmonization with other countries. So any of that can be done with CEPR-TFI, who primarily deal with AI and data visualization and machine learning kind of technologies. Now, so I would definitely ask everyone in regulation or policy to take a look at CEPR-TFI and see how they can help. And the best way to actually find out how much to regulate is to play around with things. So use the regulatory sandbox, for example, which many countries have now. And that's the best way to see what works and what doesn't. If things can be speeded up in terms of licensing, that's great. So the regulatory sandboxes in Singapore, in the UK, in many of the countries around the world, especially in the Middle East and Asia, are catching up on that. And that's a really good model to look forward to.
I completely agree with this point. Innovation, financial innovation is moving so fast that we need a little bit of help and interaction between the private sector and the authorities, and RegTech, CEPR-TFI, and sandboxes are certainly very helpful in order to allow to the good technology to develop. That is our main goal. There are then other aspects that one has to be a little bit more cautious. For example, Amit mentioned global stable coins. There is certainly the idea that in general global stable coins could be very useful for remittances, especially for the reduction in the cross-border payment. But again, as discussed before, this data network externality activity feedback loop makes regulation very challenging, because we are really considering technological companies that have billions of users. So this means that with the implication for the smooth functioning of the payment system, for the stability of the financial system, for the implication of monetary policy, in this case, we need to be a little bit more cautious and understand first. So it's not that we have to just ban. It's to understand and to help also the development of the good technologies. And this, unfortunately, takes a little bit of time. You all know about these initiatives about the G7, the G20 to study with the working group on stablecoin. I'm sure that we'll know more, we'll know better, and will be also helpful to have the right approach for this new technology to develop in the right way. So there are instruments to be fast. There is also sometimes we have to be cautious.
Okay, so I think I have clearly failed as my role as a moderator, because everybody's converging and agreeing. So I think this is time now for some questions from the audience. Please, Mark.
Yeah, I wonder if the panel could go back to a point that I made in the introduction, which is the potential benefits of the technology for consumer decision making. Because you talked a lot about regulation, the bad things that make in terms of data manipulation. But what about the upside in all of this, and how can you capture that? I mean, I'd be interested in hearing your views on how we can sort of both research that, but also sort of get like a mental model of how this is all going to play out.
So I think in terms of benefits, I think we apologize that we spoke a little too much about the negativities, but I think the benefits are quite tremendous in terms of what technologies can offer. If you take a banking model, there are benefits coming at 3 or 4 different points. So one is where the data comes into the bank or the enterprise. So we have startups now trying to bring in new data points, which Mark has talked about in the beginning. It could be social media data. It could be new data points from biometrics. It could be new data points from new kinds of KYC methods. For example, in Germany, we have video-based KYC now. So all of these new data points are coming into the bank or the enterprise. So that's one big impact that startups are made. Now, once the data has come into the organization, managing the data is another huge area of improvement that fintechs have done. So managing the data means segmenting it to the right kind of groups, ensuring data privacy and security on it, ensuring that regulations are being complied at the right levels, and the kind of rule management has changed as well, in that we can now apply rules based on 10,000s or millions of parameters, which we couldn't before machine learning happened. And rules can be adapted to data groups and customer groups and departments and the cost of the transactions, and in many, many forms. And finally, data comes out of the bank or the enterprise. There are a lot of startups now focused on data visualization and how to share data effectively and efficiently to the customers or to investors or to employees. So I would structure it in those three forms in the context of a bank and say there are startups playing in all of these three segments in very, very effective ways. And of course, when you look at household finance, it's not just helping the banks, but targeting them directly if they don't have a bank account through the form of robo-advisory or advisory kind of situations, financial inclusion, education around financial inclusion. There is a whole new group of people who are brought into the banking system. There's a whole group of people who don't necessarily have to be brought into the banking system, but are given tools now to deal with their day-to-day finances. So new groups, new markets, the ability of people to target more countries than ever before. I think all of this have been made possible directly to the consumer or indirectly through the bank, I would say, with the help of fintechs.
Yeah. Very quickly, what I think could be potentially very interesting from a consumer perspective is to, so the problem when it comes to data is that the bargaining power that an individual has when it is facing one of these giants is obviously asymmetric, to say the least. So helping consumers to think about ownership of data. So it's not a fait accompli that these data are owned by the big tech, by the banks, because ultimately they come from our searchers, our likes, the articles we read, the information that we supply. So technology can be used to inform consumers that so GDPR, by the way, part of the GDPR is that you can ask for your data, make it portable, and so helping consumers understand this process, understanding also what is the level of privacy which is associated to the data that you are releasing. In Silicon Valley, there are initiatives to try, of course, to overcome this asymmetric bargaining position by having coalitions of consumers that together they bargain access to the data to banks, to the big tech. So they're called labor data unions, or it's a principle of the old collecting societies for musicians, for instance. So these are where technology can be used very efficiently in order to ultimately leave it to the consumers to make informed choices. But once you have also, you're starting from a position of power with an asset which is your data.
Yes, I'll just add one thing. So I think, as has been said, there are lots and lots of products and services being offered by fintech, which is a good thing. For example, there are firms out there which are helping consumers manage liquidity. If they are really vulnerable, distressed households, the only way to go right now in the US is a pawn shop or a payday loan. But if you can work with some of the fintechs who can have access to your payment, your income statements, they help you manage liquidity at much lower rates than what a payday would. So that's a great thing. And so I think there's a balance there. That's why I think it's not completely clear which way we want to go. But let's have, there was another question right at the back. Yeah, please. You might need a mic or something just to...
Or stand up and shout.
From the comment, also banks do not give data, even if to their senior economist. You can understand, I think. Okay, you said that the regulation can help the startups, the fintechs, from collapsing. Can you elaborate a little bit on that?
Yeah, absolutely. So let me take the P2P lending space as an example. They were not highly regulated, and two major P2P, peer-to-peer lending companies collapsed in 2015, and that whole space started diving in terms of valuation, and not many new entrants came into the space in the UK anymore. So it was a kind of lesson for all of us that even though it's a very interesting space, if you don't handle data privacy seriously and customers don't trust you, and if you don't manage your liquidity very well, then you're going to collapse. And I think what I'm looking for is the new industries like challenger banking and robo-advisory and anything that touches a vulnerable households around the UK. I wish they would be regulated so that we don't see that collapse anymore, because they have savings, and they have. And once we see a couple of them collapse due to bad practices, we could see several of them collapsing and affecting the whole sector. So I'd rather have regulations and protection offered to the consumers than see that happen.
Okay, I think we have probably one very last quick question, and then we can wrap up because we are hitting the time constraint. Over here. And there are drinks. Yeah, so and then, yes, there are drinks, exactly.
Thanks. So there have been a lot of claims made by many on the panel and also many in the world about the advantages and disadvantages of fintechs and big tech. I'm wondering what you think we can do to enhance access to data by academics in order to investigate and test some of the implications of this, and particularly to learn whether, to estimate the magnitude of these impacts on consumer welfare. And
so I can take this to share my experience. There is, for example, opening of some big techs to the use of data. For example, Ant Financial has a research center where they share the data with the academics, and you can go there and have access to the data around regressions, and also publish potentially paper. Obviously, they have to be vetted, and there is a control regarding sensitivity and so on. Typically, the interaction of the academia with the big tech is via protocol. That is, the academic design the test, send the test to the big tech. The big tech run the regression, and sometimes we have difficulties in terms of speaking the same language, because maybe that they're more tech guy, we're more on the econometric part. And then there is the control could be done on site. And this is something that is related with the problem of confidentiality. We have the same problem for the use of credit registry in central banks. And the solution is that you allow to someone to enter the site and to replicate the results. There are solutions that could be adopted also with big tech. We have already a lot of experience with the confidentiality of data for central banks.
In my experience, which is very limited and very peculiar, I don't have great expectations. If you want to try to get some data, go to the complainant in the antitrust cases, or then go to the Yelp, or go to the. So in the past, this is interesting actually. There was a super interesting debate up to 5 or 6 years ago when the big question was Bing versus Google. Is it really? Is there a scale effect? It's just the size of the network that matters, or is it the algorithm? No? And Google was saying, no, it's not the size. The economies of scale exhaust pretty soon. And there was a super interesting debate between, at the time, it was Preston McAfee, who was the chief economist of Yahoo, then Microsoft, and Bing and Alvarium. And then because they were meeting in court, and it's too much money at stake in these antitrust cases, then the CEOs, both of them Indians, they decided not to have a war anymore, and they stopped. So at that point in time, in 2014, then Microsoft stopped their complaint against Google and stopped releasing data, and you haven't seen a single bit from any one of them. So Amazon has 280 PhD economists, okay? Pat Bajari is their own guru in machine learning techniques and is at the frontier of our field. So ask yourself, what can they get from us? Okay, so they can get some publicity. Okay, so either you go to smaller firms and then really we have the tools, we have the time, we have, or sometimes, which is perhaps more interesting, Pat Bajari is a friend, but is an engineer. He's an engineer. He wants to make things efficient. He wants the algorithm to predict, and he doesn't care about policy, which is their limitation. When they are so, he doesn't see Amazon as a company with market power. He's obsessed with making the product arriving in the market, not in 2 days, but in 1 day. Not in 1 day, but in 2 hours. And it goes on and on and on, without understanding that in the algorithm that they use, they may crush competitors on the way. You cannot do that. Okay, you cannot do that if the long-term effect is bad for consumers overall. Okay, so where we can help is also sometimes we can frame policy questions, especially if these companies are motivated by customer care, etc., in a way that they don't necessarily see. Okay, and the last suggestion, but it's impossible. Don't talk to the lawyers, because if I talk to the lawyers, they just see negatives. They don't see any reason for doing that. Okay, you publish in Econometric, so what? Okay.
So there are a few regulatory sandboxes that have universities part of them. I would say reach out to them. There's the Fintech sandbox in Boston. There is the Monetary Authority of Singapore sandbox in Singapore, and a few others who are willing to share data with academicians. So that's where I would go.
All right. I'll just add one comment to a comment that was made earlier that banks also don't share information. I think what has happened, it's true that banks have traditionally not shared information, but because of regulation and supervision that they are forced to sort of do, they had to share some data at least. You're right that maybe very micro data was not available, but a reasonable set of data was always available to check for their stability and so on and so forth. Here the issue is that we have no such information. So I think it's just a matter of scale and degree here. Think about JP Morgan right now. JP Morgan has established a center where you can actually access their microdata and come up with research. We are hoping that Amazon and Google and Facebook will do that as well. But it's a wish. But I think if we keep pushing and asking and going with them, hopefully we can get that data as well. Okay, on that note, a positive one hopefully, I want to thank the panelists. Thank you for your time and your perspectives. It was very useful to hear different views on this topic, which I believe is an evolving area, and I think that's what hopefully everybody got, that we are still thinking about various issues. Again, I would like to thank Andreas Fuster for helping me organize this, and hope everybody enjoys the drinks after this. Thank you.
Thank you.
No.
One second, with a sneak promotion for a CEPR event in London. We're hosting the launch of the Geneva reports on the future of banking, and that's on Tuesday evening in London. So if you've not heard about it through the CEPR channels, please look it up. You are free on Tuesday evening. You're very welcome.
Thank you.
Thank you so much.